What I am about to walk you through is the single most important piece of financial intelligence you will hear in 2026. Your broker, your CFP with the framed certificate on the wall, that nice young man from Edward Jones. None of them have spoken these words to you. Not because they don't know, they know. They know because their firms wrote the internal memos on it in the 1,980 seconds. They use it themselves. Their parents use it. Their senior partners use it. They just don't tell you. Because you are the product. You are the tax revenue. Picture a 68-year-old man named Robert. He lives in a paid-off 3-bedroom ranch in Mesa, Arizona. He spent 36 years as a regional sales manager, never made more than $145,000 a year. But Robert was disciplined. He maxed his 401k. He bought Apple in 2003, Microsoft in 2009. He held through 2008, through COVID, through the 2022 bond rout, through the AI mania of 2024. On February 12, 2026, Robert opened his Schwab statement. $1,240,000. A self-made millionaire. Robert's wife needs a new knee. $48,000 up front. The roof needs $22,000 after the last monsoon. Their grandson is starting at Arizona State and they want to help. $30,000. Total cash need, $100,000. So Robert does what every retiree in America has been conditioned to do for 60 years. He calls his broker and says the 7 words that are about to cost him $250,000 in lifetime wealth. Sell $100,000 of the Apple. What Robert just actually did, in legal and tax reality, is voluntarily hand the United States Treasury approximately $15,000 he never had to pay. His cost basis on that Apple stock was roughly $8,000 from 23 years ago. He realized a long-term capital gain of about $92,000. At his income level in 2026, he pays the 15% federal long-term capital gains rate, $13,800 to the federal government. Arizona slaps another 2.5% on top, $2,300. Then, because his modified adjusted gross income just spiked, his Medicare Part B premium for 2027 gets hit with the IRMA surcharge, another $2,100. And because his provisional income crossed a phantom threshold, an additional chunk of his Social Security just became taxable at ordinary income rates. Robert wanted $100,000 in cash. Robert had to sell $118,000 of stock to net the $100,000 after taxes. That extra $18,000 was money he had earned, compounded for 2 decades, money that should have grown for his grandchildren. Gone, sent to Washington to pay for a bridge in a state he's never visited. And at an 8% historical return, that $118,000 would have been worth about $254,000 in 10 years. He didn't lose $18,000. He lost $250,000 in future compound growth. Now picture another man. Same age, different rulebook. He also needs $100,000. He does not call his broker. He calls his private banker and says 9 words. Draw $100,000 against the pledged asset line. 48 hours later, $100,000 lands in his checking account. He pays the surgeon, the roofer, writes the tuition check. He sells 0 shares of stock. He pays 0 in capital gains tax, 0 state tax. His Medicare premium does not move 1 penny. His portfolio is still fully invested, still compounding, still growing at market rate. And he just spent the bank's money at a rate lower than what his portfolio is earning him. This is called buy, borrow, die. It is the single most powerful tax avoidance framework that has ever existed in the United States Internal Revenue Code. It has been hiding in plain sight since 1916. The people you trust with your life savings will swear they weren't sure if it applied to retail investors. Of course they were sure. They use it themselves. This is not official tax advice. It is a survival guide for a rigged tax code. Consult a fiduciary who actually understands high net worth strategies before implementing any of this. The strategy has 3 phases. The Vanderbilts used it. The Rockefellers used it. Warren Buffett uses it right now today. Larry Ellison uses it. Every billionaire on the Forbes 400 uses some version of this playbook. Phase 1. Buy. Acquire and hold appreciating assets. Do not sell them when possible. The asset can be stocks, index funds, real estate, a private business, anything that appreciates over time. The IRS does not tax unrealized appreciation. Your $100,000 of Apple grows to $400,000. Uncle Sam doesn't see a penny because nothing has been realized. The phantom income is invisible to the tax code. Phase 2. Borrow. When you need cash, do not sell the asset. Pledge it as collateral and borrow against it. Banks will lend you 50% to 70% of the value of marketable securities at interest rates lower than a credit card, and those proceeds are not taxable income. Because debt is not income. The IRS cannot tax a loan because a loan must be repaid. This is the most beautiful loophole ever carved into American finance, and it is enshrined in over a century of tax case law. Phase 3. Die. When you die, your heirs inherit your stock portfolio. Under Internal Revenue Code Section 1014, write this down, IRC 1014, the step-up in basis. The cost basis of every appreciated asset in your estate is reset to the fair market value on the date of your death. Decades of phantom capital gains, erased, vaporized, wiped from the IRS ledger as if they never existed. Your heirs sell the stock the day after the funeral. They pay 0 capital gains tax. They take the proceeds, pay off the loan, and pocket the rest. Generational wealth transferred. The federal government gets nothing. That is the entire playbook. 3 phases: buy, borrow, die. Now the evidence. Because this is not a YouTube hack. This is the explicit, intended, codified architecture of the United States tax system. The capital gains tax was enshrined in the Revenue Act of 1921. From the very beginning, it had a critical structural feature. A capital gain is only realized when the asset is sold. Until you sell, no matter how much your asset has appreciated, the IRS treats your gain as invisible. This is the realization principle, and it is the foundational keystone of the entire framework. In 2026, federal long-term capital gains rates: 0% if your taxable income is under $48,350 single. Though almost no retiree with a meaningful portfolio falls into this bracket once RMDs and Social Security kick in. The middle bracket, $48,351 to $533,400 single, or up to $600,050 married filing jointly, pays 15%. Above those thresholds, 20%. And if your modified AGI exceeds $200,000 single or $250,000 married, the net investment income tax, that 3.8% surcharge, stacks on top, taking the federal rate to 23.8%. Then add state tax. California taxes long-term capital gains as ordinary income, up to 13.3% on top of federal, for a combined rate of 37.1%. New York, up to 10.9%. New Jersey, 10.75%. Oregon, 9.9%. Florida, Texas, Nevada, Wyoming, 0. Which is why every California billionaire has a primary residence in Wyoming, even if their actual life is in Bel Air. But even in zero-tax Florida, the IRMAA cliff hits you. In 2026, if your MAGI as a married couple crosses $212,000 by even $1, your Medicare Part B premium jumps $74 per month per person. Cross $266,000, $185 per month per person additional. Cross $334,000, $295 per month additional. At the top tier, over $500,000 MAGI, $443.90 per month per person extra. Over $5,000 a year per person. All because you sold stock to pay for a kitchen remodel. A capital gain isn't just a 15% federal hit. It's 15% federal plus state plus IRMAA, plus increased Social Security taxation, plus the lost compounding on every dollar you sent to the government. The all-in real cost of a $100,000 stock sale for a typical upper-middle-class retiree in 2026 frequently runs north of 25%. Your broker did not tell you this. Why didn't your broker tell you? Because your broker is paid on assets under management. If you sell stock to pay your bills, the AUM goes down and the broker's compensation goes down. If you borrow against your portfolio instead, the AUM stays exactly where it is, and actually grows because the portfolio keeps compounding while you spend the loan proceeds. The broker has every economic incentive to recommend borrowing, and yet they don't, because compliance is terrified of suitability lawsuits, because pledged asset lines aren't a profit center for retail brokerages the way mutual fund commissions are, because they assume you're not sophisticated enough to handle the conversation. Here is what a portfolio line of credit, also called a pledged asset line, or PAL, actually looks like. You go to Schwab, Fidelity, Morgan Stanley, Goldman Sachs, or any major brokerage where your portfolio sits. You ask for the lending desk, not your trade execution rep, the lending desk. You establish a pledged asset line. Because your collateral is liquid marketable securities, the underwriting is fast, and there are typically no closing costs, no application fees. Diversified blue chips and broad index ETFs get advance rates of around 70%. Concentrated single stocks get 30% or less. Treasuries up to 95%. On a $1 million diversified portfolio, you'll typically get approved for a $500,000 to $700,000 credit line. The line just sits there available, like a giant home equity line on your stock portfolio. No monthly minimum payments unless you draw. No annual fee at most major firms. When you draw, the rate is typically SOFR plus a spread. In the 2026 rate environment, with SOFR around 4.3%, a typical PAL runs 5.5% to 7.5%, depending on line size and relationship. There is no amortization schedule. No maturity date. You can carry the balance for 30 years. The mechanical magic. You borrow $100,000 at 6.5%, $6,500 a year in interest. Meanwhile, your $1 million portfolio, fully intact and fully invested at a 7 to 9% expected long-run return, generates $70,000 to $90,000 a year in growth. You are spending the bank's money at 6.5% while your money grows at 8%. The spread is in your pocket. The risks are real. Be honest about them. The margin call. If your collateral value falls below a threshold because the market drops sharply, the bank can demand you deposit additional collateral or pay down the loan immediately. If you can't, they liquidate your stocks at the bottom of the crash. This happened during the COVID crash in March 2020 and the 2022 rout. The wealthy mitigate this with 3 rules. Never borrow more than 25 to 30% of portfolio value, even if the bank approves you for 70%. Maintain a diversified collateral base heavy on index funds and high-quality bonds. Keep a cash reserve outside the portfolio to cover 6 to 12 months of interest payments. Follow those rules and the margin call risk is genuinely manageable. Ignore them and you are playing with fire. Interest rate risk is real too. SOFR can rise. Model your strategy at higher rates. And behavioral risk, once you see a $700,000 credit line sitting available, the temptation to overborrow is real. Discipline is the prerequisite. The step up in basis at death is the master stroke. The part even most accountants don't fully grasp. When you die, under IRC Section 1014, every appreciated capital asset in your taxable estate gets its cost basis stepped up to fair market value on your date of death. The decades of phantom capital gains, gone, erased. Forgiven by the federal government as if they never existed. Your heirs sell the stock, pay off the loan, keep the rest. In 2026, with the federal estate tax exemption at $15 million per individual, $30 million for a married couple, the vast majority of upper-middle-class retirees have zero federal estate tax liability anyway. The step-up applies to everyone, regardless of estate size. You don't need to be rich. You just need to die with appreciated assets in your name. The Action Plan. Step 1. Review your taxable brokerage account. Note your unrealized gains. The bigger the embedded gains, the more powerful this strategy is. If your portfolio has very low unrealized gains, the urgency is lower. Step 2. Call your custodian's lending desk, not your financial advisor, the lending desk. Ask for the rate sheet, the advance rates by asset class, the maintenance margin requirements. Get the paperwork. Step 3. Establish the line before you need it. The worst time to apply is during a market crash when you actually need cash. Set it up during good times and let it sit as a financial fire extinguisher. Step 4. Set strict personal rules. Borrow no more than 25% of portfolio value. Reserve the line for true cash needs. Maintain a separate cash reserve for interest payments in down markets. Step 5. Consult a fee-only fiduciary to integrate the PAL into your estate plan, trust documents, and beneficiary designations. Step 6. And this is the one nobody tells you. Do not gift highly appreciated assets to your children while you are alive. If you do, they inherit your low-cost basis instead of getting the step-up at death. Hold the appreciated asset until death. This is counterintuitive. Every wealth transfer book tells you to gift early. For taxable brokerage accounts with embedded gains, holding until death is mathematically superior in the vast majority of cases. The reason your broker, accountant, and advisor never told you any of this is because the financial services industry is not in the business of saving you money. It is in the business of extracting fees while telling you it is saving you money. The fee-based advisor charging 1.2% per year on a $1 million portfolio takes $12,000 a year from you. Over 20 years with growth, that's nearly $500,000. For advice that doesn't include the single most powerful retirement strategy in the U.S. tax code. Buy, borrow, die. 3 words. A framework that has built every American dynasty fortune, from the Carnegies to the Musks. And it is available to you. Bring it to your advisor. Mention IRC Section 1014 and pledged asset lines in the same sentence. Watch them squirm. Watch them tell you it's not appropriate for someone in your situation. Then ask them why it's appropriate for everyone they call a private wealth client, but not for you. Demand an answer. You earned that $1 million, every penny. Don't hand the IRS 25% of it on the way out the door, because nobody told you there was a better way. Now you know there is.